Okay, so good afternoon, everyone. Uh, Welcome to GPUVerse Live Dialogues. We are episode number 6. My name is Rudy Shushani. I'm the founder of DX Talks. I'll be your host and moderator for today's really interesting session. We have lovely people that have joined us with a lot of value. And it's really exciting to see that our global community that is tuning in once again from developers, founders, investors, and innovators, all coming together to explore how decentralized compute is redefining the new world of digital economy. And for those who are first time that have joined us, live our GPUverse dialogues is about global thought leadership powered by GPU.net. We bring the brightest minds across AI, deepen generative AI, and decentralized finance, and this is where our topic is. Over the past few weeks, we explored everything from AI-driven compute to decentralization and infrastructure and tokenized assets. And today we're diving in a new fascinating front, which is called decentralized finance, DeFi, versus the compute from centralized data farms to decentralized compute grids. And let me tell you, I've just been in GITEX for the whole week, and we're seeing innovation beyond the world. There's a lot of things that are happening. And I think all of us today are spread across the world, but they are joined from the UAE in this exceptional episode, each from I won't say city, we're all in Dubai, but each joining from a corner. So we're going to be unpacking how compute itself is emerging as a yield bearing asset, the roles of GPU empowering DeFi ecosystem, and what happened when finance meet infrastructure at scale. Without further ado, let's meet our distinguished guests, speakers for today. We have the Amalia Groschal, co-founder, Ordinal Council, and CEO of Mirai Fund, joining from UAE. Vincent Karad, CEO of Polymath, joining from Canada. And there's a story with Vincent. I met Vincent 3 days ago by fluke of mistake with a common friend in a car getting out of traffic. So that's how it goes here in Dubai. It's really, really crazy. Christian Davis, also global head of distribution and innovation from REL Insurance from the United Kingdom, also joining from the city of the future, Dubai. I'll be moderating this dialogue that will be guiding us through this deep dive into the convergence of finance, compute, and decentralization. So let's start this without further ado. And let's start with the first question. And Amalia, I'm going to start with you. You're the co-founder of Ordinal Council, the CEO of Murai Fund, and I'm sure you've been in the DeFi space since the beginning, and I know for sure because we've talked a lot about this. How can the compute resources evolve into mainstream yield-bearing asset class, and what parallels do you see in early DeFi yielding in terms of how things are really changing in this space also?
Well, if you're looking for at the early DeFi that we have since pretty much 2016 plus, we have three different basic divisions. One is staking with the validators for proof of stake chains, right? Second is LP provision, where we're providing liquidity to different liquidity pools. And the third is lending, where we either use collateral or provide liquidity for the ones that borrow based on their tokens, right? So looking at these three basic DeFi yield farming strategies, we could kind of, based on that, build three different strategies for tokens that represent GPU compute as well, right? So the first, where we're looking at the comparison of staking with the validators for making the chain secure, we could actually stake the GPU representing tokens in the so-called node. It wouldn't be exactly the same node that is securing the chain, but we could so call it node as well. Because we will be able to get the yield from the inference. Whereas when we're keeping the GPU token, we wouldn't be able to do that. So So in order to get this yield from the inference, we need to stake. That would be the case number one. Case number two, where we're comparing the old school liquidity provision on DeFi protocols, we could obviously very easily provide liquidity by adding this token paired with BTC or any other token, and get yield from either one-sided LP or both-sided LP, depending on how the market goes, and hedge here and there, either make money or lose money. Please remember that. And also with liquidity provision, obviously we can easily provide liquidity with GPU representing token versus stable coins, and obviously also get yield from the swap fees from that pair. Or even the last case with the second comparison would be where we can stake in the liquidity pool the staked version of our GPU representing token that is already staked with so-called node that we discussed in the case one, and then still have liquidity pools based off that, which is a bit more complex, but it's also very interesting. And the case number three is obviously a comparison with the typical DeFi lending, where our previously discussed tokens can be used as a collateral to borrow the stables or other tokens, considering that those tokens, one, have their own value on their liquid market, as well as they also are yield bearing when they're staked. So obviously the second stake, without saying, is where we are using as a collateral the stake token. So yeah, that's probably it, and then we can borrow based of that some stables, right?
Yeah,
I
it's very
think I
interesting.
covered every possible case as usual. I tried.
Yeah, that's for sure. You mentioned a lot of things in terms of how it changed from almost nearly a decade now. And then when the term was coined later on, because I'm sure there was a lot of activities with the rise of Ethereum and how it works. I'm gonna jump to Vincent. Uh, Vincent, you are innovating on different fronts in terms of tokenization of the global financial system. What do you think the smart contracts role of the standards and digital identity frameworks play in enabling cross-protocol compute markets?
I think it plays an interesting role. And just a bit of background, just first on Polymath. Like, we've been at this since 2017. Like, we've built our own layer one for tokenizing virtually anything, and we have been doing that actually as well. I think there's actually several key challenges and things that we can unlock for sure. And one is actually just the compliance complexity. So, and the compliance complexity when it comes to enabling compute credits on the GPU cycle, as an example. Even on the valuation and on the standardization side, for sure, the variability of compute resources and availability makes the valuation difficult. But by creating a standard around that, we can definitely actually help to ensure that there's consistency in pricing and reduce risk. And then even on the liquidity side, compute tokens, when you've tokenized actually, GPUs, when structured as securities, it can be traded actually on regulated alternative trading systems as well. And this just gives actually greater visibility and even custody and traceability around the tokenized securities, because it'll allow for the on-chain auditability once these security tokens tied to GPU cycles actually can be created.
Yeah, very interesting. And that's the beauty. You mentioned 2017, so you've been there also for a while. One of the early innovators trying to determine this new tokenization of how it's going to be in the future. So let me jump to Christian. What models could support decentralized insurance for compute downtime or smart contracts failure? And how close are we to insurable DeFi compute in this market? Are we there yet?
To be honest, just again, some background of Realm. We've been around since 2019. We're a fully licensed and regulated commercial insurance company. We insure over 1,000 Web3 projects around the world in over 36 different jurisdictions. And these are traditional commercial insurances as well as completely and utterly bespoke insurances like slashing, smart contract failure, a variety of on-chain risks. And we've been having multiple conversations around decentralized compute. When you look at the way decentralized AI is also working, if you're looking at all how people are trying to extract multiple different options for decentralized storage, decentralized processing power, ultimately it's what are people actually needing it for? With DeFi, you're starting to see a big transition of TradFi coming into DeFi because they're able to control it a little bit better. They're able to put the private networks together. They're able to take public blockchain and put a load of restrictions around their own pools. With decentralized compute, there is still a kind of, well, who the hell am I actually working with right now?
Exactly.
And that's the big problem. Yeah, and what everyone likes to understand, and it does work in different jurisdictions, but especially in the West, is if something goes wrong, someone likes to point the finger at someone, and someone is ultimately going to sue them, and that's essentially what the support and the preface of what insurance does. It's there for the oh, something's gone wrong moment. Let's hope that they've got insurance in the back end. And I think for real credibility of decentralized compute, there needs to be that support structure, that accountability, which at the moment, usually we're the ones who get asked to look at building some insurance product behind it, and we haven't, transparently. That's kind of the only real point I could say from a decentralized compute perspective. But you're talking, what you did mention in your question was, kind of parametric and how we could use on-chain insurance to potentially help that. Well, everyone knows that when you have technology that is on-chain, if it goes down, it's very public. That's the joy of a smart contract.
It should not go down. That was the original design, but then sometimes something happened.
Exactly. And what you have to look at is how is that decentralized compute actually working? Because on the front end, it could be like, we have 70,000 GPUs all around the world well, great. If those 70,000 GPUs are all in a single person's data storage or single warehouse, then things can still go down, because whilst the GPUs themselves might be decentralized, they're still in a centralized location.
Yeah.
That'd be another thing that would be going down that rabbit hole of. But when you look at how you could potentially build a product around that, ultimately,
that's what you guys did.
Well, exactly, that's what we do. And you could look at uptime, downtime. You could look at, if it is all on chain, as soon as it goes down within a certain period, and if there's liability under the contract, you could parametrically pay out for the losses associated with that. If A happens, B pays, flat out.
Indeed. And that's the beauty of having a DeFi insurance product on chain, so that you can also be able to manage this. I'm going to jump back to my dear Amalia. What frameworks or risk structures would be institutional funds comfortable with allocating capital to GPU staking or compute based on yield strategies? I know you've been, into this for a long while. What's the latest frameworks that could be used?
Well, for us, definitely 3 basic principles are the most important, and then we will go more detailed for each scope that gets integrated as completely new, which in this case, that would be something new for institutions. Obviously, the first one would be having some sort of tracking system for the hardware use, including electricity cost occurred and the ROI from the inference. So that would be some sort of a transparency layer. So that preferably could have been done on chain, which I'm just making an assumption as I'm not quite familiar with colleagues' product from the insurance, but I assume that they may have such layer getting built already done, which is a very good thing. Second would be an institutional grade insurance that would be directly integrated within a custodian, for example, custodians such as BitGo, which I do believe so far has the highest grade of the highest amount of insurance possible for such products on chain. And aside from big tier one custodians like BitGo and others, there could have been also a very specific boutique insurance company that covers the on-chain assets, right? And the third principle that matters to us will be obviously, that goes again without saying, a healthy ratio of on-chain collaterals and liquidity. As simple as that.
Yeah, interesting point of view. Christian, do you think traditional underwriting principles can be reimagined for GPU-based lending protocols and performance-backed collateral, or it's gonna be impossible? They need to reinvent themselves to go into this mentality.
So this is the amazing thing about insurance, right? Because insurance is a 350-year-old industry, and it started off with two guys sitting in a coffee house in the city of London, gambling as to whether or not a ship was going to come back across the Atlantic.
Okay.
Insurance moves slowly. It's always reactive rather than proactive, and yes, you could take traditional underwriting principles, like credit default swaps, right, and credit risk, and you could apply it to lending protocols, GPU-based lending protocols, and performance-backed, collateralization. But whilst you might have the base premise of it, you're going to have to do a load of work of then how to apply the remainder of it. You might be 20% of the way there. And then you've got to do the rest of the hard work and the hard lifting. And that's also why, we have an entire product development team who just do the research around these things. So yes, there are some traditional insurances, even on the uptime side, like technology, professional indemnity or errors and omissions, some of the cyber side, which you're looking at business interruption or non-physical business interruption, that pays the loss of net profit due to a downtime. You could potentially take the fundamentals of 3 or 4 different types of insurances to actually then build a product like that. But not easy.
Indeed. I think that needs a new mindset of how it's going to work. And this is where I'm going to jump to Vincent. Could compute credits function similarly to yield-bearing tokens or stable assets in the DeFi portfolio? And how would liquidity and compliance be balanced in that space? Is Vincent with us? Yeah. Coming.
Okay, so we're talking about stable coins, right?
Yeah.
So could compute credits be similar? Oh, yes, they could be. I think when they're tokenized as securities, definitely, because it's an investable product. So they could function similar to DeFi compatible yield-bearing assets while maintaining, a form of regulatory compliance. Some of those yield-bearing mechanisms could be generated to the recurring revenue streams that are, distributed via smart contracts and tied to the revenue that's in the services that are created actually via the GPUs. And so you think about them as like tokenized compute credits or compute bonds that you're offering actually, either fixed or variable returns based on, the resource utilization. What's interesting is that they're there's stability actually with such a product and some backing, because it's, you could tie it even to a service level agreement, collateralized compute units as well. And it balances liquidity and compliance, right? And so these security tokens that would be then tied to GPU and compute credits, which are then similar to stable coins, they can then be traded actually on a centralized or even a decentralized exchange as well. And I think that really just ties to the overall theme where, anything can be tokenized, including actually what we're speaking of here. And as long as there's an underlying asset, and that underlying asset is, definitely, again, it's energy being used to create something else that can be tokenized.
Very interesting. I loved how you took it as a point of view also in terms of how things are really changing in that aspect. Amalia, I'm gonna jump back to you in terms of traditional DeFi, where yield prices is actually priced by volume, congestion level, and inflation. How do you think DeFi compute markets price yield given uptime, performance, compute, utilization as a variable? It's a new way of thinking, I would say. Do you agree with me?
Mm-hmm. I think all of those mentioned by you variables, like uptime, performance, compute utilization, are important, but let's not forget about power demand response, which is a super, super crucial
Okay.
variable, because as we are going to be doing more and more inference, we are going to be utilizing more GPUs, maybe even ASICs specific to AI, which are already coming out, done by, I do believe, one very known project has been just delivered by Google, if I'm not mistaken, which is very interesting ASIC for AI. But anyhow, we're starting to use so much energy, and we don't have enough transformers for that. So we are pretty much energy short, and in parts of the world, for example, like Texas in US, having demand response on electricity is a very common thing, because that's based on the ability of electricity to be transported within time and space. Sorry to be so cosmic about it, but when I say space, I mean actual kilometers on planet Earth.
Yeah.
Sorry. So that depends on how far can we deliver the electricity on Earth, but also as most of the electrical cords are unfortunately still outdated, that isn't possible to deliver it too far. And also we cannot store electricity for too long, sometimes depending on the facilities, right? So that means if someone is storing a lot of electricity, he will be dispersing it depending on when is it possible and when it is needed. So I think we will end up doing demand response on electricity pretty much internationally. That's the first thing. And with that being taken under consideration, this is a super, super, if not most crucial variable that we have to take into consideration. And with that being said, we come back to, again, a transparency layer that I have mentioned previously, where all of those variables can be closely monitored. And based of that, those being monitored, we can display on DeFi dashboards the real-time yield, as well as for the future yield estimations. We can do threshold based out of historical data, and let's say based of if we're looking at a demand response of electricity, that would be also on like prognosis of weather, because that also is very dependable. So we can do threshold-based predictions to display, let's say, yearly ROIs of the yield, and having that estimated the worth of staked tokens, because we also talked about tokens being staked for yield farming and for collaterals, etc., etc. So the whole scheme, the whole machine pretty much needs to have those estimations being there. But then once we actually create those thresholds based of these variables, we will be able to, on the other side of the market, to bid if these tokens actually will hit those thresholds or not, right? And provide liquidity and insurances based on that. So I think it's a very, very interesting field. I can go on for hours.
Yeah, thanks. Let me jump to Christian. What assurance, financials, or technical must be in place for institutions to trust DeFi compute ecosystem at scale? You mentioned couple that today kind of the trust is still not there in terms of different things because we don't know who. So how can we put some assurances? What are you looking for when you want to ensure something?
I think realistically, it's just the fundamentals of risk management, right? And this is where DeFi has really taken leaps and bounds. It's all well and good. You know, I've been in the crypto industry for a very, 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 very long time. Realm, interestingly, has this license that allows us to actually put crypto on our balance sheet. We're also able to collateralize reinsurance vehicles with crypto and pay losses in crypto and denominate limits in crypto. We're still a TradFi insurance company, but we have the ability to do that as well. And it's the fundamentals of risk management, right? It's about transparency. And that's what TradFi is needing from DeFi. And that's what TradFi is going to need from decentralized compute. It's who, what, how, and when. It's like, where is this infrastructure based? How decentralized is it? What are the support structures behind it? And Amali was talking about weather just then. When you're starting to look at different jurisdictions, electricity, what's uptime and downtime of the electricity provisions? When we look at just the basics of Bitcoin mining and the fact that when Texas all of a sudden got cold, they had to turn off a load of electricity being supplied to the Bitcoin miners. So all of these things have to be taken into consideration. They're just the basics that we ask from any of our clients, really. So we all know, I think that we all probably got into crypto for the whole the panacea of full decentralization around the world, down with the banks, and things like that. But there is that trust element that everyone still needs to have. And whilst decentralization can enable trust, it can also really and utterly get rid of it as well. So yeah, that's just some of the fundamentals and just basic transparency, which a lot of these things don't necessarily have.
Great. I'm going to jump to Vincent. You've been there for a while also. And then I'm sure you worked with regulators and you've talked with a lot of regulators and we've seen left or right. They're ready or they're not sometimes. How do you think regulators view tokenization from a non-financial resources like compute, it's not money, it's more of a service, it's more of infrastructure, it's more of power. What safeguards are needed for investors' protection, do you think?
Well, I think they'll look at it as some of the other asset classes are starting to unfold. And I'll lean on, things that we have tokenized, which are revenue streams. We've tokenized whiskey barrels actually for distilleries so that they can actually enter in and provide them with operating capital. And the last thing is real estate. Like real estate it's an asset class that people have invested in actually through REITs, but now it's being tokenized directly. And if you think about this is yet another asset class. It's how you're going to structure the investment, what type of security is provided to the investor, and then who's underwriting it, right? At the end of the day, if you have, a lawyer or a broker dealer that's providing the underwriting on this particular investment, and it's tied to, a solid business model actually and an investment thesis, then from a regulatory point of view, it'd be approved. I would say that typically the first of one of these classes is they go through the most painful part in scrutiny. But everybody benefits actually from the first guy going out because he went through the most pain. So as long as the safeguards are there, KYC AML has got to be there. There's got to be proper disclosure requirements. The governance and the recourse actually aspect side of, of the security token tied to whatever, what type of governance is around it. And then lastly, the auditability, right? Is it transparent? Is there on-chain tracking as well? Can I see, who's owning what? But more importantly, actually, it's the oracle that feeds the data real time as far as what that security token tied to that particular new asset class, GPU resources, or et cetera. What is it really worth? And how is that verified, right? Because at the end of the day, something's only worth actually based on what somebody's willing to pay for it. But when you're evaluating a security token based on GPUs, which is basically energy that's creating that, well, there's value that's there, and that's the revenue stream that it's delivering.
I'm going to jump in actually, Rudy, and say, Vince kind of just gave what the opening question set that we would be asking around the risk management of these companies, right? To even start to look at insurance, we would ask exactly the same as what Vince just asked. And the fascinating thing is as an insurance company, we get to ask those questions, and a lot of people working, who want to work with some of these companies don't get the opportunity to ask these questions. So we end up with a lot more information. And you said that, it's usually the everyone benefits from the first person to take the leap and do all the hard work. It's exactly the same for us. The first company that goes through that whole process of, assisting in information sharing, allowing us to build a first ever product, other people in the industry then benefits from us, and from that pain. So Vince, you could just be an underwriter if you fancy.
We're in the pain train together.
Yeah, exactly.
Maybe you're in first class and I'm in economy right now.
Maybe, and that could be a great change. Christian, I'm going to continue with you. Can really on-chain insurance protocol become that foundation for capital inflow into DeFi compute networks, much like credit rating, enabling early bond markets or other possibly solutions? What's your take on this?
I think that, what people have to understand is insurance is an incredibly regulated industry in every single jurisdiction around the world. And insurance is not just insurance on the front end. It's not, if I give you this and, if I lose, I pay out this. There is something called reinsurance. There is something called retrocession. And then you also have something called ILSs and cat bonds. So insurance is one little part of the cake. Reinsurance is the insurance of insurance. Retrocession is the insurance of the insurance of the insurance. And then you have something called cat bonds and ILSs, insurance-linked securities, right? So the on-chain solution doesn't necessarily take all of that into consideration. And also transparently, it would be TradFi or big institutional on-chain providers or liquidity providers who would have to provide the collateral to this if it wasn't from centralized insurance companies like Realm. Because the losses are big, quite frankly. And the on-chain decentralized public insurance options, quite frankly, Rudy, if you're going to put $10,000 into an on-chain insurance pool, we're going to need many more of that, because a loss could be $5 million, $10 million, $20 million, $30 million. Some of these losses that we've seen as just some of these big DeFi hacks are close to $1 billion. So the on-chain public insurance market is never going to be able to get that. It's not going to be able to sustain the losses. You need TradFi in insurance, and we can bring that on-chain, and we actually have the ability to do that, to be able to truly take that into, to the next level. And
is it going to be like the ETF moment, or maybe something different? Or not necessarily?
I think it might be a little bit different, because the other thing is insurance contract terms are typically 12 months. So that immediately reduces the liquidity provisions or liquidity possibilities. Like you can't go in and out whenever you want. It's locked up for at least 12 months. But the returns, depending on the risk, can be between anything like on some of these like on-chain pools, for example, can be between 4% and 20%. And if you put that into a regulated infrastructure and something as TradFi as an insurance, it can be incredibly positive. What I would be, and we'll definitely be having a chat with Amalia and Vince after this, is the conversation that was just had around stable coins, and could decentralized compute and tokenized decentralized compute be an alternative to stable coins? I'd be very interested to figure out how, because the whole thing about a stable coin is it is stable, and it is obviously one-to-one backed. But transparently, we have these things of insurance-linked securities. We have the ability to build reinsurance vehicles entirely on chain, entirely denominated in crypto. So if there is a way that we could look at tokenized decentralized compute from a liquidity perspective, we could potentially build reinsurance vehicles behind the industry specifically for that, also collateralized with that asset.
Very interesting. Vincent, I'm gonna take one more last question, and then I'm gonna do a roundup after Amalia. What do you think the challenges and opportunity of tokenizing this GPU cycles from compute credits into something more liquid financial instruments and compliant in the same time?
The challenges, I don't know if there really are any challenges. Like if the framework is in place, like other assets have been tokenized. If you're the first one, like we were talking,
we're going to be solving the puzzle.
You're going to be solving the puzzle for everywhere. You're laying the groundwork actually, and you're going to be like, I will say our first customer that did tokenized real estate in a particular market was the longest. Now everybody actually is benefiting as a result of that. So Rudy, if you want to actually take the leap of faith, I'd say, we're here to support you. I'll help you actually from a platform point of view, and I'm sure there's an insurance plan that actually can be tokenized along with it as well.
Here we go. We just need the financing, and this is where Amalia can come in.
How many followers are on here? We can get the financing right here on this call.
Very interesting.
Vincent is a closer, definitely.
What do you think, Amelia? Can we get the financing?
I shall not be answering this question here because I am a person of bias, as I am a panelist in here, so I should be wanting for this to happen. So
I want your answer as a biased person.
I'm being a diplomat in here, right? I'm trying not to answer this question, but with Vincent saying like, "Hey, we have like more than 500 people listening in live," he's definitely looking like a closer. He's ready to close the 500 plus people.
Yeah.
We should definitely discuss this afterwards as well.
Yeah, Amalia, I'm going to end this with you, and then I'm going to open one question to all. How do you really envision this merging of real world assets, DeFi liquidity, decentralized compute infrastructure, transforming this whole digital capital markets, if you want to call it? It's really something changing the way we are, everything, I would say. What's your take on it?
Well, I wouldn't necessarily say changing a lot, but looking into a variety of asset classes and baskets of collaterals on chain, more than merrier, always, because looking at different subsections of markets and their crashes, not all of the markets are going in parallel. Some of the markets hedge against each other, so it's always good to have, tokenized gold, like for example the gold stablecoin from Tether Gold. We've got RWAs, for example, real estate assets that are getting tokenized. Then we've got the typical DeFi tokens, liquid staking tokens, major layer ones, layer twos, and tokens on top of these, and stables. So pretty much we can bring anything on chain as long as we do that properly, and more than merrier. But on the other side, when we look into companies holding treasuries in crypto, and when we say crypto, that we mean the tokens that represent the GPU decentralized compute. Imagine a centralized AI compute company or any other centralized AI company like OpenAI, CoreWave, Grok, which are completely centralized compute and inference companies. They keeping in their treasury crypto tokens that represent the decentralized compute to hedge against their own centralization, just in case if something goes wrong. This is very, very cool concept as well, right? It's far taken, but very cool.
Very interesting. Vincent, I'm going to start with you as I'm trying to end this nice talk. If you want to put your 2 cents into this, what are the recommendations you would say that you give to our listeners on how they could start?
How they can start like tokenization of GPUs?
How could they benefit? How could they, start the journey? How could they invest? How, could be anything in this space, because we're really pioneering the new space as we speak.
Yeah, like I think it starts off actually like with a solid, business and value proposition. Like, what is it you're trying to achieve? You're tokenizing it for what reason, right? To use that capital to invest back into additional GPUs, additional build out, and then somebody really underwriting it. And so typically a lawyer just needs to put a stamp of approval on it to underwrite it, or an investment banker, a broker dealer of some sort. But there's a lot of creativity in this capital formation space. That's what tokenization really does provide, is the ability to be creative and how you're going to actually form new ways of generating capital to invest back in your business. I think don't be shy is really what I would recommend to all of our listeners. Creativity is something to be admired in this new way of tokenizing different assets. But use a compliant chain, work with reputable parties. If people like listeners want to contact me or anybody from my firm or company, please reach out. We've got a network of, I'd say, vetted third parties that work with us that have done this before, right? And so my objective is actually to take the pain out of the the train ride that and make sure that you get to the end station actually that you need to get to.
Yeah. Very interesting, I would say. Thanks, buddy. Christian?
Yeah, I mean, I think basically following on from Vince, you can reach out if you want to explore. I'm always willing to have a conversation, but it is about that who, why, what, when. And if you want to kind of explore it, have a think about that. Have a think about the risks you believe you have, and have a think about why, or what might be required to get TradFi heavily involved in this. And as long as it's not financial guarantee, you'll be amazed at what credibility insurance can actually provide to emerging technologies, emerging industries around the world, especially as now regulation is catching up and also mandating insurances for some of these industries. So we're always very happy and very open to listen, and that's how we build some of our products. So yeah, again, feel free to reach out to us, and we've got a whole team can get involved.
Interesting. Thanks, guys. Amalia, I'll leave it to you to end this, and then would be thanking our viewers after that.
You'll have to kill me now because I lost traction
Boom,
on
boom,
the
boom.
last question. The question was still open. I lost it. It was too decentralized.
No, just
validate this question. Excuse me.
no. Just want to wind down. I just want to give them, something for them, for our viewers to take away, kind of.
What to take away? I think we have to really pay attention to demand response of electricity. Also a bit taking care of our planet, but also taking care of ourselves, making sure everything is monitored. But ASIC miners for AI are just coming out. It's going to be the next boom, so I think we're going somewhere with that. Plus, obviously, we can source electricity from different nanotechnologies nowadays, which will completely, put the world upside down of like how to generate electricity as we know it. From even a couple years ago, it will be so very different. I think AI inference, decentralization of it, and other things correlated to that are a very interesting field, and it's kind of something that may change the world as we know it, pretty much, if we're looking from a very zoomed out perspective.
Okay, very interesting. So thank you all. It's been interesting, I would say, for this discussion. We're all spread across the world, but for this event and for GITEX, we're joined into one city, an amazing city, if I can say. Huge thanks to our speakers, Amalia, Vincent, and Christian, for sharing such valuable insights. And to everyone tuning in from across the world. At GPU.net, we're building the future of decentralized compute, where compute isn't just a resource, it's an asset class by itself. And today's session was really made it clear compute power finance is converging faster than ever. So compute is the new commodity. You can own some of it, own GPU token, try GPU credits as dApp.gpu.net, launch your subnet on subnet.gpu.net, or join our Telegram community GPU network. Don't forget, the first 30 live attendees today, they will have 5 hours of complimentary GPU compute. So I've been ranking 5 hours and 5 hours and 5 hours and 5 hours. So far I ranked more than 40 hours myself. So make sure that you are also in this space so they can test your innovation in it. So thank you all for joining and being part of GPUVerse Live Dialogue. Stay tuned for our next episode. We're going to continue exploring how AI, DeFi, and decentralized compute are shaping the next era of innovation. Until next time, keep building, keep scaling, and think GPUVerse. Thank you, guys. Thank you, ladies. And we'll see you soon on the floor. Have a great one.
Thank you.
Thank you.
Thanks.